You've been told your whole life, invest early, invest often. Let compound interest do the work. And then the most successful investor on the planet looks a 20-year-old in the eye and says, it's damn near impossible. So which is it? And what does that mean for everything you thought you knew? Let that contradiction sit for a moment. Because this isn't some bitter, broke contrarian ranting on the internet. This isn't a cynical blogger with a chip on his shoulder trying to go viral with a hot take. This is Ray Dalio, the man who founded Bridgewater Associates, the largest hedge fund on earth, managing over $150 billion in assets. A man who started with nothing, built everything, and spent 5 decades studying the mechanics of wealth, markets, and economic cycles with a level of obsession that borders on religious. When Ray Dalio speaks about investing, you don't scroll past. You stop, you listen, and then you think very carefully about what he actually said and why he said it. So let's be precise. Because precision matters here. Dalio wasn't saying don't invest. He wasn't telling young people to stuff cash under a mattress or give up on financial growth entirely. What he was saying, with the brutal honesty of someone who has seen the inside of this machine for 50 years, is that the version of investing most people are sold, the one that promises ordinary people extraordinary wealth through stock market participation, that version is a fantasy dressed up in spreadsheets and optimistic projections. And here's why that matters so much. The financial industry, the brokerages, the fund managers, the financial media, the app-based trading platforms with their colorful interfaces and celebratory confetti animations is built on one foundational story. The story goes like this. You are a regular person. You have a modest income. But if you invest consistently, if you put money into index funds every month, if you max out your 401k, if you trust the process and stay the course, you will build real wealth over time. Compound interest will do the heavy lifting. Time in the market beats timing the market. Just keep buying. It's a beautiful story. It's emotionally compelling. It's built on real mathematical principles, and it is profoundly, dangerously incomplete. Here's the analogy that captures the gap perfectly. Imagine someone hands you a map and tells you it leads to treasure. The map is real. The treasure exists. But what they don't tell you, what's printed in ink, too small to read, is that the map was designed for someone starting 10 miles closer to the destination than you are. That the path it shows runs through terrain that looks flat on paper, but is actually uphill the entire way. And that by the time most people following that map arrive at the location marked X, the treasure has already been claimed by the people who had better maps, faster vehicles, and a head start you were never told about. That's the investing illusion. The math works, the principles are sound, but the conditions required for ordinary investing to produce genuine life-changing wealth, the starting capital, the time horizon, the absence of financial emergencies, the tax efficiency, the fee structures, the inflation-adjusted real returns, those conditions are quietly, systematically stacked against the person who needs wealth building the most. The data is unambiguous about this. The Federal Reserve's own research shows that the top 1% of Americans own more than half of all stocks and mutual funds. The top 10% own roughly 89%. The bottom 50%, the people most aggressively marketed to by the investing industry, own approximately 1% of all stock market wealth. 1%. The market has been running for over a century. The advice to invest has been given for generations. And after all of it, the bottom half of the country owns essentially nothing in the market. That's not bad luck. That's not laziness. That's a structural reality that the just keep investing narrative conveniently skips over every single time. And Dalio's $10 million number? That isn't arbitrary. It isn't pessimism. There is a specific, cold mathematical logic behind it. And when you understand it, it will fundamentally change the way you see every piece of financial advice you've ever been given. 1%. That number should haunt you. Generations of ordinary people, faithfully following the advice, consistently investing, trusting the process, and the bottom half of the country ends up owning 1% of market wealth. So when Dalio mentions $10 million, when he draws that specific line in the sand, he isn't being dramatic. He isn't trying to discourage anyone. He is pointing at a mathematical reality that the financial industry has every incentive to obscure and zero incentive to explain clearly. Let's break it down, because the logic is brutal, and once you see it, you cannot unsee it. Here's the core problem with investing at ordinary scale. Returns sound impressive in percentage terms. 8% annually, 10%, 12% in a good year. Those numbers look powerful on a chart. They feel meaningful when a financial advisor presents them in a glossy brochure with an upward sloping line. But percentages are meaningless without context, and the context, the part that changes everything, is the base. 8% of $10,000 is $800. 8% of $10 million is $800,000. Same percentage, same market, same effort. Completely different financial reality. At $10,000 invested, even with perfect discipline, even with consistent contributions, even with decades of patience, the absolute dollar returns in the early years are so small that they are effectively neutralized by forces working silently against them. Let's name those forces, because they are relentless. Force 1. Inflation. The real return on an investment isn't the number your brokerage account shows you. It's that number minus inflation. If your portfolio returns 8% in a year when inflation runs at 4%, your real return is 4%. Half of what the headline number suggests. And during periods of geopolitical stress, which we are living through right now, inflation doesn't behave politely. It surges. It erodes. It silently confiscates the purchasing power of returns that looked perfectly adequate on paper. For someone with $10 million, a 4% real return is still $400,000. Life-changing. Compounding powerfully. For someone with $50,000, a 4% real return is $2,000. Less than the cost of a single car repair. Barely perceptible against the backdrop of a real financial life with real expenses and real emergencies. Force 2. Fees. The investing industry is extraordinarily good at making fees seem small. A 1% management fee sounds negligible. An expense ratio of 0.5% sounds practically free. Over a 30-year investing lifetime, fees of just 1% annually can consume 25 to 30% of your total accumulated wealth, not your returns. Your wealth. For large investors, institutional funds, family offices, the ultra-wealthy, fee structures are negotiated, minimized, and structured with tax efficiency baked in at every layer. They have the leverage to demand better terms. They have the sophistication to structure holdings that legally minimize tax drag across generations. For the ordinary investor, you pay the listed price. You accept the standard terms. You absorb the full friction of a system that was designed by and for people with far more capital than you have. Force 3. Volatility in human behavior. Here's the one that charts never show. The theoretical return of the stock market over long periods is genuinely impressive. The actual return captured by ordinary investors is dramatically lower. Study after study, including the widely cited Dalio research, shows that the average retail investor significantly underperforms the very index funds they invest in. Why? Because of volatility. Because markets drop 30, 40, 50% periodically, and ordinary investors, people with real financial pressures, real mortgages, real job insecurities, don't hold through those drops the way the theoretical model assumes they will. They panic. They sell. They wait for safety. They buy back higher. They repeat the cycle. This isn't weakness. This is what happens when the money you're investing is money you actually need. When a 40% portfolio drop doesn't just affect your future, it threatens your present. The wealthy investor with $10 million can watch a market crash with relative equanimity. A 40% drop leaves them with $6 million. Painful on paper, survivable in reality. They hold, they recover, they compound. The ordinary investor with $50,000 watches a 40% drop reduce their account to $30,000 and, simultaneously, loses their job in the recession that caused the crash. They don't hold. They can't. The math of their life doesn't allow it. Same market, completely different experience, completely different outcome. This is what Dalio understands from 50 years inside the machine. The game isn't rigged in some conspiratorial sense. It's just structurally designed in ways that favor scale. That reward existing capital. That compound advantages for those who already have them. And the $10 million threshold? That's roughly the point at which the math genuinely starts working the way the brochure promised, where the absolute dollar returns become large enough to outrun inflation, fees, taxes, and the inevitable turbulence of a financial life. Below that threshold, for the vast majority of ordinary people, investing is not the engine of wealth creation. It never was. So here's the question that Dalio's warning inevitably forces you to ask. If investing can't get most people to genuine financial freedom, if the math doesn't work at ordinary scale, then what does? What did Dalio himself actually advocate for? What do the genuinely wealthy actually do to build the capital base that eventually makes investing powerful? Because there is an answer, a clear one, and it reframes everything, every financial decision, every career choice, every conversation about money you've ever had. But it's not what the investing industry wants you to focus on, because if you understood it clearly, you'd spend a lot less time on their platforms. And they know it. The investing industry has one job, not to make you wealthy, to keep you engaged. Engage with their platforms, subscribe to their services, convinced that the next fund, the next strategy, the next rebalancing will finally close the gap between where you are and where you want to be. Because an investor who understands what Dalio actually said, who truly internalizes it, becomes a very different kind of financial actor, one who is significantly less profitable for the industry to serve. So let's talk about what Dalio actually advocates, what he said beyond the headline, what the financial media conveniently trimmed from the conversation when they ran the clickable quote about damn near impossible. Because the full message isn't despair, it's a redirect, a fundamental, paradigm-shifting redirect that changes not just how you invest, but how you think about the entire architecture of your financial life. Here it is. Investing is not the engine of wealth. It is the preserver of wealth already built. Read that again. Let it land. The sequence that the financial industry sells you goes like this. Earn money, invest money, watch money grow, become wealthy. Investing is positioned as the transformation engine, the mechanism that converts ordinary income into extraordinary wealth. But that's not how genuinely wealthy people actually built their wealth. Not Dalio. Not Buffett, not the vast majority of people sitting on real generational financial security. They built income-producing assets first. They created businesses. They developed skills so rare and valuable that the market paid for them at extraordinary rates. They built equity in something, a company, a practice, a brand, a proprietary system that generated cash flow independently of their time. And then, once that engine was producing real capital, they invested, not to get rich, but to protect, preserve, and efficiently grow wealth that already existed. The sequence is completely reversed from what most people are taught. Think about it through this lens. Dalio himself didn't get wealthy by putting money into index funds every month. He built Bridgewater. He created an institution. He developed an investment philosophy so distinctive and so rigorous that the world's largest pension funds and sovereign wealth funds paid him to manage their capital. The investing came after the building. The returns compounded on top of a foundation that was constructed through entrepreneurship, expertise, and obsessive execution. Buffett, same story. He didn't get wealthy buying stocks as a salaried employee. He built an investment vehicle. He created Berkshire Hathaway as a business that generated float insurance premiums he could invest before claims came due. He engineered a structure that gave him access to capital and leverage that no ordinary retail investor could replicate. The wealthy don't just invest differently. They build differently first. And here's the behavioral insight that ties all of this together. Most people approach their financial life in the wrong order. They try to optimize their investments. Before they've optimized their investments, they spend enormous mental energy researching stocks, rebalancing portfolios, and debating asset allocation. While their income remains fixed, their skills remain static, and their earnings ceiling remains exactly where it was 5 years ago. It's like obsessively tuning the engine of a car that doesn't have enough fuel to reach the destination. The tuning might be technically impressive, but it doesn't solve the actual problem. The actual problem, for most people trying to build wealth from scratch, is not investment strategy. It is income architecture. How do you build income streams that grow? How do you develop skills that compound in value over time? How do you create or acquire assets that generate cash flow independently of your hours worked? How do you build the capital base that eventually makes investing genuinely transformative? Those are the questions that precede the investing conversation, and they are almost never asked by the platforms, the apps, and the financial media profiting from your continued engagement with their products. Dalio's warning to that 20-year-old wasn't nihilism. It was a gift. He was saying, don't waste your most valuable years, your highest energy, your greatest risk tolerance, your peak creative capacity, trying to optimize a mechanism that wasn't designed to work at your current scale. Build first. Create first. Earn at a level that generates real investable capital. Develop expertise so valuable the market has no choice but to reward it generously. Start the business. Develop the skill set. Build the asset that generates cash flow before you need to draw it down. And then, once the foundation exists, invest with discipline, with patience, and with the emotional stability that only comes from having capital you can genuinely afford to leave alone through the inevitable storms. Here's the final truth, the one that reframes everything. The wealthy don't keep their financial secrets in complicated investment strategies. Their real secret is hiding in plain sight, in the sequence, in the order of operations that nobody selling investment products has any incentive to teach you. Build the engine before you fuel it. Create before you compound. Earn at a level that makes investing meaningful before you spend another hour optimizing a portfolio that the math says cannot take you where you want to go. Because Dalio didn't build $150 billion by following the advice he was given at 20. He built it by understanding something most people spend their entire lives missing. The market rewards those who arrive with capital. It was never designed to create it for those who don't. And now, you know the difference.